Okay, welcome. If you're listening, you want the important stuff fast. Today, we're really digging into something pretty major happening right now. Market interest rates. They're falling, and falling quite sharply.
Exactly. It's a big shift. So we're going to unpack why that's happening, what's driving it. We've got financial data, a report from a big global credit rating agency, and what local securities firms are now saying.
Right, pull it all together. So what's the immediate thing? What really kicked this off?
Well, the latest numbers show the 3-year government bond yield just hit a low we haven't seen in 3 years.
3 years, wow.
Yeah, and corporate bonds are kind of following that same downward path. But the really interesting bit, foreign investors.
Oh, what about them?
This month, they've suddenly started buying up government bond futures in a big way. A complete flip from when they were net sellers just before.
Okay, that is a shift. Why? Why this sudden interest from foreign investors now?
Seems like two main drivers here. First, there's this growing feeling, this anticipation that the central bank's going to have to cut interest rates soon.
Right, lower rates ahead.
Exactly. So if you hold mid to long-term bonds now and rates fall, the value of those bonds goes up. Potential for capital gains.
Makes sense. And the second reason?
That's tied to the currency. Our local currency has been getting stronger.
Okay.
So for foreign investors, that increases the need to hedge their bets, protect their returns, and it also opens up these little windows for arbitrage, making money on tiny price differences across markets.
Got it. Rate cut hopes and currency moves making our bonds look attractive. Okay, let's zoom out a bit. How does this fit with, the general state of the economy?
It connects directly to that first quarter GDP number we saw. The contraction.
Yeah, that wasn't good news.
No. And that slowdown is really what's feeding these expectations for the central bank to step in. Monetary easing, making money cheaper to borrow, trying to give the economy a bit of a jolt.
And it sounds like the big forecasts are pointing that way too. What are the experts predicting?
Well, the big global credit agency we mentioned, they're floating the idea of a potential full percentage point cut in the policy rate by the end of the year.
A full point. That's significant.
It is. It implies not just one cut, but maybe several. And it's not just them domestic securities firms here. They've also changed their forecasts, now expecting more cuts, more easing.
Okay, so the consensus is shifting towards more action from the central bank. But hang on, weren't there still some worries, even if the wider trade talks go, okay, I remember something about specific sectors?
Yes, exactly. It's important. Even if the broad tariff stuff gets sorted, that credit agency specifically warned about potential sector-specific tariffs. They actually mentioned cars, automobile exports.
Ah, right. So that risk hasn't gone away.
No, and that could still really hurt. Plus, they're still worried about weak spots domestically. People not spending much, companies not investing. That's dragging down their growth forecast, too.
So potential external risks linger, and internal demand is still sluggish. What about the government? Any expectation on how they might react, especially with an election coming up?
The rating agency thinks the new administration, whoever takes over, will likely lean towards expansionary fiscal policy.
Meaning more government spending?
Pretty much. Things like supplementary budgets, trying to directly inject some cash into the economy to support growth.
Okay, lots of potential policy levers being discussed, monetary and fiscal. But amidst all this uncertainty, there are still underlying strengths, right? The agency didn't suddenly downgrade us.
No, absolutely not. That's key. Despite the current slowdown and these risks, they actually reaffirmed the country's stable credit rating earlier this year.
What was their reasoning?
They pointed to our strong external position, our balance with the rest of the world, and solid government finances. Basically saying we have buffers to handle this kind of stuff.
Okay, good to remember. So let's try and wrap this up for you listening. Interest rates are dropping sharply, mainly because the economy is slowing down and foreign investors are betting on central bank rate cuts.
Right. And forecasts suggest those cuts could be pretty deep, maybe a full percentage point by year end. But there are still risks, specific tariffs, like on cars, and weak spending at home.
And we might see the government step in with more spending after the election to help out. But fundamentally, the country's credit rating is stable thanks to some underlying financial strengths.
So the thought to leave you with is this. How do these falling rates, these shifting economic forecasts, maybe impact your world, your financial plans maybe? And it's worth watching that interplay, between the central bank's rate decisions and what the government might do with spending. How will that combination actually steer the economy? Something to keep an eye on.